Welcome to my Technical Tuesday latest update. I think this is number 5. We're going to look at the Stochastic Oscillator today. Definitely something that I do use. Right, so here you see on my screen I've got the settings for it. I think these are pretty standard. %K periods 10, 3, average period 3, and then %D period is 3. So I'm just going to add that to my chart now. And there you see the Stochastic Oscillator at the bottom of the page. A bit of background, the Stochastic Oscillator is a momentum indicator that compares the closing price to the price range over a given period. So, in other words, it shows the close relative to the range over a set number of periods. In a bull trend, prices should tend to close near the upper end of the range, of course. In a bear trend, prices tend to close near the low of the range, and therefore the Stochastic Oscillator is designed to follow the speed or momentum of that market. In other words, if prices are not closing up near the high upper end of the range for the day, the Stochastic Oscillator will not be as strong as bulls would hope it is. Stochastic Oscillator contains 2 lines. The first line is the %K, which is essentially the raw measure used to formulate the idea of momentum behind the oscillator. Second line is a %D, which simply a moving average of the %K, and the %D is considered to be the more important of the 2 lines, as it is seen to produce better signals. Okay, so generally we use the past 14 periods in the calculation. As a rule, momentum changes direction before the trend. So therefore, divergences in the Stochastic Oscillator can be used to indicate potential reverses in trends. If the Stochastic Oscillator is starting to turn lower in a bull trend, or is having lower highs when the price is showing higher highs, this indicates that momentum is changing. Price is failing to close in the upper area of the range, despite the continuation of the bull trend. Okay, so this is my favorite indicator, at least, and I do find it useful for identifying overbought and oversold levels as well. I use the slow stochastic, not the fast. Okay, so this is an up-to-date chart of the gold price going back over 1 year. This is a great example, actually. So as the market as the market bottoms out, you can see that the Stochastic Oscillator is in oversold territory. In other words, it's under the 20 line. So we're aware that it's oversold, and then as the oscillator turns higher and the fast line, the grey one, crosses over the red one, you can see that we accelerate quite quickly, and this is matched almost perfectly in timing by the price move. As we begin to get overbought, there's a little warning that we're getting overbought, and eventually the price does react and has a small correction, as you can see, bringing allowing the oscillator to trend lower. We then bounce. You see we're developing into a bull trend. Of course, we don't know we're developing into a bull trend, so this is something you've got to be careful of. The market will spend a long time above the 80 line when we are in a bull trend, and this is when you've got to be careful. Trend identification is extremely important. If you're looking to sell every time we get overbought and we're in a bull trend, you're going to lose a lot of money. So eventually, when the market does flatten out and it flatlines for a good 3 or 4 months here, this is when the Stochastic Oscillator is fantastic as help you spot trade opportunities. So we don't know that it's flattening out, but down here when we bottom out, the oscillator will help us to buy, and as you see, they cross over, which is bullish, and then up through the 20 line, which is bullish, and that will take you, if that was to take you into a long position, that would have worked really, really well. Now, the first peak, not so well. We actually only trade sideways, which is quite common, but that does allow the oscillator to move back from the overbought situation to about the halfway line. Then we rally again, but this time it would have been a good opportunity to sell if you combine it with other things. For example, look at that big negative candle up there. A couple of big negative candles, in fact, bearish engulfing. So with other tools that you know from your technical analysis toolbox, that would have indicated that perhaps it would be a good sell if you thought we were entering a sideways trend and the moving averages are actually moving quite sideways. Down we go. You know we're at least in a bull trend because we have been trending high since December, so you're happier buying into dips, and the oscillator becomes very oversold here, but much way below the 20 line. Crosses over, becomes bullish up through the 20 line, showing some strength. Bang, market takes off again. becomes overbought. You see the pattern. So when we trend sideways, this is very, well, it's a lot easier to trade this. When the market decides to then take off, you've got to be careful, because you can spend a lot of time in the upper band in the overbought territory, and then that can cause problems. You're getting short into a bull market, something you definitely don't want to do. If you are in a bull trend, you want to be buying into dips. This is when the oscillator works. If you can identify that we are in a bull trend and then we do get a corrective phase, become oversold, then this will indicate to you that, hey, look for some buying opportunities. But for timing, you need to look at some of the other tools that I've explained in previous and that I will explain in future Technical Tuesday videos. Again, caught the peak quite nicely here, and we're now catching a trough. So to summarize, this works particularly well in a sideways moving market, or it works well looking for buying opportunities in a bull market, and of course looking for selling opportunities in a bear market. But if this is stubbornly staying in overbought territory and the market is trending higher, do not think about entering a short position. Stick with the trend. If the market is holding in the upper area of the range in the oscillator, then it shows us a lot of strength. Okay, lastly, we have what we call a divergence indicator when we use a stochastic oscillator. So this is how it works. We are in a bear trend in this particular segment of the market that you see here from August, September down to December of 2016. At the very end, you can see how the oscillator does catch the peaks and troughs. At the very end of this move, in the last sort of month or so, the price is clearly continuing to trend lower, but the oscillator is doing the exact opposite. It's it's flattening out, and actually, if anything, trending higher. So it's not reinforcing the bearish message here. And as you see, there is more and more indecision in the market in these candles, the way they're closing sort of unchanged here. We've got some dojis. We're not closing at the lower end of the range on all the candles. As you can see, we're getting some shadows down here with the long candle wicks, and we're certainly getting some blue candles in here. So it's indicating that there could be a momentum change, and this is what the oscillator is clearly displaying by starting to trend upwards, certainly flatten, if anything, starting to trend upwards. So this is what we would call a negative a positive divergence. The price is trending lower, but this is starting to trend higher, and this will indicate to you that the momentum is potentially changing, and there could be a trend change. And of course, in the end, there was a trend change. Okay, so that's a brief outline of the stochastic oscillator to give you an idea of how it works. I do try to keep these Technical Tuesday videos down to below 10 minutes, so I don't send you all to sleep, but I do have a course which goes into all the things that I show on these Technical Tuesdays in a lot of detail. And when you sign up for the course, you also get access to me for free forever. So if you're interested in really educating yourself and learning exactly all the techniques that I use every day on and analyzing up to 20 or 25 markets, then I do highly recommend that course.